And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to a holiday shortened week. And trust me, I already have vacation head because Friday I'm on vacation all of that following week along with Brent. So we've been working hard this year. It's our 1 week of vacation every year that we take. So I'm heading out on Friday. Brent, you go anywhere for your vacation, or are you just gonna go see your grandkids? What's up?
It's staycation this year.
It's a staycation this year.
Yes.
I'm doing a staycation too. It's in Greece, but I'm doing a staycation. I'll be in Greece the whole time. So
very good.
But yeah, definitely a staycation. But anyway, we will have coverage for you next week. So we're going to have videos for you. Brent's been working hard to put together some of our best of clips. So you'll have something to watch next week while we're gone, and then of course the following week we'll be back in action, of course, with all the live updates. This week, of course, is a holiday shortened week. Thursday is Independence Day, of course, July 4th. And that's kind of interesting because over the weekend, so of course, July 4th, Independence Day, very important for the country. And then, of course, following that, we had the Constitution, Bill of Rights, all these type of things. Over the weekend, a very, very important win for constitutionalism, which was that the Supreme Court ruled on Friday to basically get rid of what's called the Chevron Deference. And did you hear about this?
I did not hear about this.
You did not hear about this. Oh, this is very important.
This is why I tune in each morning.
Oh, there you go. See, you're going to learn something this morning.
Yes.
So the Chevron Deference has been something that's been in place for the last 30 years or so. And what it allowed for is that, so Congress passes a law, right, of whatever it is. So we're going to pass a law on emissions as an example. So the Congress passes a law that says, okay, we need to reduce emissions, whatever that means. Well, then the EPA can come in and just, under the Chevron Deference, we're allowed to just basically make rules of their own doing regarding whatever that law is. So in other words, they could take a law and these unelected bureaucrats could just make up rules as they went, and that was considered to be the law of the land, so to speak. Well, under this, now that the Supreme Court has removed the Chevron Deference, now these agencies no longer have that power to just interpret the laws and impose their will upon the citizenry of the United States at their will. So this has a very important impact for the ATF, EPA, Department of Health and Human Services, all these type of things. Now, of course, you're going to get a lot of arguments coming out. It's like, oh my gosh, this is terrible for everybody because this is going to remove, the ability for these lawmakers to do things. It's going to endanger everybody. No, it just means that they can't arbitrarily impart their views, whatever those are, onto the American population. If they want a rule change, they're going to have to go to Congress and get a law change, right? And so they go to Congress and say, hey, we need, you pass this law that says we need to reduce emissions. I'm just picking that. That's an easy one, right? Because we've had that for years, right? So we've done unleaded gas and all this type of stuff under the emission issues. So we have this law that says emissions. We need laws that also say what that means. And so the Congress is going to have to actually do a job. They're going to have to work, and they're going to have passed laws basically specifying what needs to be done. So huge win for constitutionalism over the weekend, and you're going to be hearing a lot about this, particularly going into the election as we get there, because this is going to be a very important change about how laws are made in the future and what the implications are on the American public. So anyway, just keep a watch out. This is going to be a big thing. This is probably one of the most, the Supreme Court has done a lot of rulings, Roe v. Wade, of course, that was a huge one. This is probably even more important than returning Roe v. Wade back to the states in terms of reproductive rights, etc. So every state now, under this repeal of Roe v. Wade, has their own ability to make their own laws, that's where it should be in the first place, of course, at the state level. Again, as we've talked about before, government only has two jobs, which is national security, infrastructure, and defense. So, everything outside of that should belong to states. Education, health, all those should be state decisions. We elect our local officials for that. That's where it should stay. Roe v. Wade, obviously, that was very important. This is probably the biggest decision the Supreme Court has ruled on in history. So in terms of the last few years in particular. So anyway, keep a watch. This is going to be very important. So let's talk a little bit about the markets. We got a lot of stuff to get into this morning. A lot of stuff happened over the weekend. I got a lot of stats for you. So get your coffee. We're going to go through it all. But here's what you need to know before the bell this morning. The market is up right now a little over 15% for the year to date, right? So it's been a very, very healthy start to the beginning of this year. Market continues to ride this wave higher. Now, on Friday had a little bit of a, kind of a sloppy day on Friday. Not surprising. It was the end of the quarter, a lot of rebalancing. So again, bonds were under pressure on Friday, rebalancing through that. We saw a lot of pressure on different areas of the stock market last week, rebalancing as well. So again, we're through that. We're now starting today is the first day of the second half of the rest of your life. The rest of the year. So this is, so again, this is important. Now, typically when markets are up 15% or 10%, whatever, in the first half of the year, it tends to lead to a second half of the year that is also positive. So it doesn't mean that the market just keeps going higher indefinitely. This was the same story that we saw last year. At this point last year, we had this exact same market. Then we had that 10% correction in July, August, September. So again, just be aware that just because the year tends to end on the positive note doesn't mean you can't have a decent correction in that process. And I would still expect one. July tends to be a fairly decent month for the markets. So again, kind of continue this market, kind of continues to trend higher through July. August, September, October tends to be weaker in election years. Again, we've talked about this before. Markets kind of de-risk ahead of the election itself, just because I don't know who's going to win. What does that mean for taxes? What does that mean for tariffs? All those type of things. So markets tend to de-risk. And then once we find out who the new president is and what those policies are likely to be, markets tend to rally into the end of the year. So look for a correction sometime this summer as an opportunity to add exposure if you need it. But again, overall, first half of the year has been very good. We're continuing to kind of just ride here. But again, importantly, we haven't done, we talked about this, a couple of weeks ago. We said, hey, look, markets are getting overbought. And that's pretty much going to mean the markets are kind of limited to the upside. And that's very much been the case over the last, really kind of 3 weeks. The market hasn't gone anywhere. It's been a lot of up and down, back and forth. It seems like we're making progress. Really not. But we just kind of been consolidating here. Now, that's good, right? That we're consolidating and not, having a much bigger correction here. So that kind of gives this market the ability to work off some of this overbought condition. We're still not done with that process yet. So again, look for a bit more limitation to the upside. Got to work off this overbought condition. We're working through that process. We are on a sell signal temporarily. That's going to also limit upside. So again, just kind of trade accordingly. Look for a lot of rotation within the markets itself. But again, we're just still kind of working through that kind of a process right now. And look, it's been a great year. Again, we're up over 15% total return basis, up a little, almost at 15% on a price-only basis this year. So again, markets are doing fine, nothing to worry about here. But again, likely limited here near term until we work off some of those conditions. But that'll give you a better opportunity to add exposure if you need that. Okay, so that's what you need to know before the bell this morning. When we come back from the break, we're going to talk about this dichotomy with the consumer. We went through a lot of charts and graphs this week in the newsletter. I also want to talk about second quarter earnings, which start today. We'll get back all of that coming up right after the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So, I have a story for you this morning. In the trials and tribulations of the Roberts family. So, yesterday, our cable went out, the cable and internet went out on Saturday. And so we were out, it's like, what's going on? And so I checked Comcast, and there's no outages in our area. Couldn't really figure out the deal was. So I called Comcast, and they showed up yesterday to the house to fix the problem. And so he's outside working on the internet. He comes in and knocks on the back door, and he says, "Hey, come here a minute, and I want to show you something." And so we go outside. Now, of course, we've had all these thunderstorms lately, right? That's been going on, these high winds, all this type of stuff. And so we walk outside, and he shows me where the cable goes from the telephone pole to the house and then connects to the house. And there's a box, right? So he opens up the box, and all the cable going into that box is completely melted. And then he says, "Now look up at the pole." And up at the pole, right, it's all completely melted. So it's like something's happened here. So I figured, hey, we must have got hit by a lightning strike during all those storms we've had recently. He goes, "Don't worry about it." He says, I'll just replace the line. You'll be good to go here in a few minutes. I'm like, awesome. So I go inside to the house, and my wife's in the kitchen. She's making dinner, and my son's hanging out on the couch watching some television. And when he cuts the cable to replace it, the whole house starts. It looks like poltergeist. Literally, I mean, all the lights are flashing. We hear popping noises. Lights are going off. They're coming back on. I mean, it looks like the whole house is completely possessed at this point. And then we can smell the electrical fire, right? So just immediately you can smell that electrical smoke, through the whole house. So I get on the phone. I call the fire department. Want to make sure the house isn't burning down. So here, we have very nosy neighbors, by the way, just to let you know this. So anyway, the fire department shows up. Now, again, I explained to them on the phone, "Hey, I know what, I think I've got some electrical thing going on. I just need you to come check the house to make sure there's no fires or anything like this." There was no haze, right? It's just, you could smell it. And I said, "But just to be safe, I've got my family there. Just, come on over and just check this thing out." So I figured they would just like casually cruise up and then, come check that. No. Not in Houston. These guys they're great. I love firemen, and I love our police officers, and I think they do a fantastic job, but they come rolling up hot, let me tell you. I mean, lights are on, sirens going. They come bailing out in full gear. They got their helmets on, axes. I'm like, holy crap, what are they going to do to my house? And so they come up to the door, and I let them in. And they check the house, and they go, well, we don't see anything, but we certainly smell what's going on. And so they go out, and they're talking to the cable guy out back. Well, at this time, my wife, like I said, is cooking in the kitchen. And so she pulled her casserole out of the stove, and she put it up on the stove, and she goes over to wash her hands, and she gets electrocuted in the kitchen. Now, I mean, it's not like electric chair type thing. But I mean, a pretty hefty shock, from touching the water. And so this starts sending off all kinds of signals through the house, right? So everything's now just kind of going haywire. And so the police officers, the firemen are outside, the cable goes outside. I go outside and say, "Hey, my wife just got shocked, washing dinner." And they're like, washing dishes. And so they're trying to figure out what the problem is. Well, it turns out all this is going on. Everything is hot, no matter what you touch. You touch the metal on the fridge. You try to open, touch a sink handle, flush the toilet. You get shocked. I mean, like the whole house is now electrified. And so we go outside, and they've got what's called the hot stick, and they're waving it in front of just anything that's got electrical wire. The signal's just going off. It's like, yeah, this thing's hot. And so it turns out that somehow, apparently, we have a lot of squirrels in our neighborhood. They chewed through the ground of the house. So the house is not grounded at this point because apparently somebody decided to chew the ground off the house. So anyway, I now have electricians crawling all over the house today. We had to spend the night at a hotel. So we had this hotel. So if you come to our offices, we're in a complex of 4 office towers. And right in the middle is an Embassy Suites hotel. Very nice little hotel. They're also dog friendly, by the way, which was important because we have 2 dogs. So we had to pack up our dogs, pack up our son, because he's still. I told him not to touch anything. He's like, hey, let me touch the refrigerator. Yeah, you're going to get shocked. Anyway, so we spent the night at the hotel last night. So I'm a little discombobulated this morning, but this is my ongoing travail with this rental house, which, by the way, I will be out of at the end of the month.
Oh, congratulations.
So we are in the process of, so right in the middle of this vacation thing, right? They were supposed to be done in May. So she's like, oh, that's fine. We'll be done in May with a remodel of the new house. We can move in June, and then we'll go on vacation in July. It'll be great. Well, they're not done on time.
No.
So they'll be done at the end of this month. So right in the middle of this, we've got to go on vacation, come back, move. But I'll be out of this rental house. Thank goodness. It's been interesting.
What a way to go out.
Yeah, I know, right? So I don't know if I've lost any equipment at the house. Well, I haven't been able to turn anything back on, right? So, but I may have lost computers and everything. So we'll see what happens. Because I mean, like literally when this was going on, and what happened is that so the squirrel had chewed through the ground, right? So the only thing grounding the house was the internet cable between the house and the telephone pole. So when he cut. So when he cut the cable, right, the house is now totally ungrounded. Right. There is no ground, and everything went bonkers. But it was the craziest thing. I mean, lights were flashing. It was just amazing. I mean, television's popping. Like I said, I have no idea how much stuff is completely ruined right now. And I have surge protectors on most everything, and those were done. Yeah. So we'll see what happens. Anyway. All right. Erica, yes, at least it's a rental. And I explained this to my son last night too, right? I said, this is the reason that renting is often better than owning, because none of this I got to pay for. And the homeowner is going to be replacing my equipment once I find out what's gone. Yeah, so, we'll see. Anyway, so sometimes renting is better than owning. All right. So a couple of things. Let me refocus my attention on what we're supposed to be talking about this morning, which is the markets. A couple of interesting little stats this morning. And when we come back from the break, I'll talk a little bit about what I wrote about in the newsletter about this consumer dichotomy. But there was a couple of very interesting stats this morning about the markets. So as I said earlier, the market, the S&P 500 is up 15.3% total return. So this is total return. This includes dividends. Since the first of the year. So as of June the 30th, the market was up 15.3% total return since the beginning of the year. Take out NVIDIA, it is only up 10.7%. Take out the Mag 7, you're only up 6.3% for the year. Now, again, when I say only up 6.3%, that's the average return that most people are probably seeing in their portfolio because they don't own just Mag 7 and NVIDIA, right? So you look at your portfolio, very likely your performance is very, I'm not up 15.3% this year. Well, if you own bonds or gold or anything else in your portfolio that's not Mag 7 or, NVIDIA, you're not going to be up as much as the market, most likely, right? Now, depends on how you're allocated. But it's very interesting. But 6.3%, by the way, is not bad. That is the strongest first half. That is stronger than just about any first half of the year, right? So, I mean, you take a look at total return years. We look at, if I can just, 6% to 7%, 8% on average for a given year, you're up 6.3%. That's a 12.6% annualized rate of return for the market. Once you strip out the Mag 7. Now, so it's been a very, very good year for the market so far this year. But again, a very big dichotomy between what's happening in the top 10 stocks versus kind of everything else in the market. And again, so again, your portfolio return. So again, when you look at your portfolio, don't assume something's wrong with it, or if you have a financial advisor and they're not tracking the market right now, nobody is, unless they have a very big overweight in just a handful of stocks, which of course is for most people way too much risk. That's eventually going to revert, and you're going to see a rotation in the market. Now, when you take a look at momentum factors of the markets, we have the highest spread between momentum and value just about at any point on record. Normally, that type of a peak marks a reversion in markets. So again, so don't just assume that just because your portfolio is not tracking the market that you see, right? What you see in front of you. It's like, well, my portfolio's not doing that. My advisor sucks, whatever. Be careful with that, because this is not a market that you should be trying to keep up with. There's a lot of concentration risk in the markets, which is fine, right? So if you're just indexing, you're doing fine. But if you're trying to run, your own stock portfolio, whatever, and you're not keeping up with the markets, there's a reason for that. If you own good value-oriented companies, now if you're speculating and taking on a lot of risk and chasing the hottest stocks, you're doing fine, right? This has been a great year for momentum chase, absolutely. But you're also taking on a lot of excess risk by chasing momentum. So just be aware of the risk you have in your portfolio. It may not seem like there's risk because of this market performance, but there is. And this also kind of feeds into investor attitudes, which we'll talk a little bit about when we come back next. So stick around. More of the Real Investment Show coming up.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
In the last 2 years, there's been a massive drop-off. Like, nobody's naming their kid Alexa anymore. But yeah, because you go, Alexa, stop that, and all your lights go off.
The Real Investment Show podcast.
And I'm sure the kids at school were getting teased. Hey, Alexa, ask a question.
Same show, your schedule.
I hadn't heard of any kids being named Siri.
Not yet. I'm sure there are. I am sure there are. And there's probably some kid named Bixby somewhere.
At realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So there's some interesting data out last week. The Conference Board came out with their latest consumer confidence survey, and also we had the University of Michigan as well. And there was some interesting data inside of that that tells you a lot about what's kind of going on between the markets and the actual economy. But when you're talking about the markets, right? Investors are super bullish about the markets. And I've posted a lot of different charts about, investor sentiment and, investor confidence and this type of stuff. My buddy over at Top Down Charts, he posted this. He has a similar graph that I have, but it's called the Euphoria Meter, which is basically a combination of forward PE, VIX, and bullish sentiment. And, PE are valuations, right? That is a sentiment index in and of itself. So when you talk about valuations, people go, well, valuations are very high, and so this means, X, right? No, all in the short term, like over 12 months, valuations tell you nothing about what the market's going to do. But it tells you a lot about investor confidence, because if valuations are rising, people are willing to pay up for earnings more and more, right? It's like, the earnings say this, I think it's going to be, Y. And so they're willing to overpay for those earnings. And that typically tends to work out poorly. But, when you have investor euphoria at current levels, it tends to mark at least short-term peaks in the markets. Now, it doesn't mean the markets crash, right? It has. Markets have crashed in the past because of this. But you at least have short-term corrections and bear markets, obviously. And we're at a very, very high level in terms of this kind of overall euphoria. But as I said, we're entering quarter two. And as entering quarter two earnings season. So starting today, we're going to start, and it really kicks off in earnest next week after the holiday. But we're going to have a lot of companies starting to report earnings. Earnings estimates have been cut sharply. In March of last year, was the first time that that the S&P put out estimates for the second quarter of this year, and they started out at $234 a share. Over the last 30 days, they cut those earnings by more than $5 a share. So we are now down to $193.45 a share. Just in the last 30 days. So we've had a very, very big decline in earnings going into this reporting period. So this will make it very easy for companies to beat estimates. And, so the market's been doing well. Despite the fact that what's really going on in the economy, again, earnings are a reflection of economic activity. Where do earnings come from? They just don't magically appear, right? It comes from revenues, which is what happens at the top line of the income statement. So we've got to go out and buy stuff. We buy stuff from Amazon. That's their revenue. Then they subtract out all their expenses, do their stock buybacks, everything else. That's how we get to earnings per share at the bottom, right? So got to have economic activity. Without that, don't have earnings. So if estimates are coming down, that means economic growth is slowing down. So again, this brings us back to this consumer confidence. One thing I do is I create a composite index of both the University of Michigan index as well as the Conference Board. And that way you just get a broader measure. These two indexes used to track pretty closely, but really over about the last 3 years in particular, they've really diverged from each other. And you can kind of see this, in this chart showing both those indexes. Both of them are declining since the peak of 2020. So confidence is weakening, but the Conference Board measure has been a lot stronger, or that I should say, than the University of Michigan. But both have been absolutely weaker than they were just a couple of years ago. So again, consumer confidence as a whole is declining. But we can combine these into an index and get a composite. But what was interesting in this latest Conference Board measure was that if you look at it by income level, right? So you take the confidence of consumers by income bracket, whether it's below $15,000 a year, below $25,000, below $50,000, et cetera. All those measures have been declining. So again, kind of not surprising that you're seeing this overall decline in consumer confidence, but it's happening across the income strata. So no matter how much money you're making, you're certainly feeling pressure with the overlying economy. So again, we combine these two together, we get a consumer confidence composite index. And again, there's a very, very big gap right now between what's happening with consumer confidence. Normally, consumer confidence is tracking along with the stock market for the most part, right? Because asset prices are rising, people feel better about things. Usually the economy is doing okay. That's why the markets are rising. And so confidence rises. But really, ever since about 2020, just kind of starting at the shutdown, ever since that shutdown, consumer confidence has diverged more and more from asset prices. So what's happening in terms of the consumer is very different than what's happening within the overall stock market. And again, not surprising, this is all about economics. But if we take the current measures, right, of how do you feel today, consumer-wise? Well, economy's not great, whatever your feelings are currently. And well, what do you expect in the next year? Those are expectations. If you take the expectations, how do you feel about next year, versus how do you feel currently, you get an index that is at levels that this is basically expectations less current conditions. You have an indicator that is normally marking recessions in the economy. So in other words, how do you feel about the economy? It sucks. That's what that chart tells you that the average consumer is saying. So the average consumer is not confident about their current conditions, and they're not confident about where the economy is going to be in 12 months. So this is important because that affects how they spend in the economy, and that affects how they're going to act. And again, asking people, how do you feel about the job market right now? Well, jobs aren't very plentiful. So, I don't see all the job availability that has been out there. And we've had a very sharp increase in consumer respondents going, jobs are not plentiful. At the same time, ask them about how's your income going to be in 6 months, right? Is your income going to be higher or lower in 6 months? There's been a steady deterioration in the number of individuals having confidence that their incomes are going to be higher in 6 months. So again, the outlook, the expectations is not one of economic improvement, right? So again, let's just put this together in terms of the economy and your expectations. And so what does that mean you're going to be doing with your money, right? Probably not going to be spending a whole lot. And this is important because there's a very high correlation between the annual change in the markets versus earnings and real GDP. So if we take a look at the annual percentage change in S&P 500 earnings versus GDP, there's a very high correlation, except a few outliers, right? Those outliers are typically coming out of recessionary periods. So you've had a big collapse in earnings because of an economic slowdown or something like this, and then you have a big surge in those earnings as everything kind of comes back online. So, but outside of those kind of isolated events, there's a very high correlation between the annual change in earnings and real GDP. And that's because where do earnings come from? They come from GDP, right? So we're there, and this is why the best indicator for the stock market is the annual change in earnings. So if you take a look at the annual change in earnings versus the annual change in the S&P 500, there's a big correlation. And when those earnings are rising, the market tends to rise. And when the forward estimates are declining, they're getting weaker. Doesn't mean they're negative, right? They're just trending lower. The market tends to underperform as well during that period. So right now we've got analysts, right, just ramping up earnings through the end of next year, even though they're cutting estimates. They still expect us to get to about $243 a share next year. So again, it's about a 18% increase from where we were. Now, a month ago, they were expecting 252 and a 20% increase. So it's come down a little bit in the last 30 days, but still very optimistic about earnings growing through next year. So again, consumers feel terrible about the market. Analysts on Wall Street are super optimistic about the market, and individual investors, individual consumers are extremely optimistic about stock prices in the next 12 months. This is a huge dichotomy, right? I feel terrible about the economy, but I am super optimistic about the stock market. But how are you so super optimistic about the stock market if the economy isn't producing the earnings growth for these companies? Right? This is all about psychology, right? They see the stock market going up every day. We've got everybody hooked up on the crack cocaine of Wall Street trading. Everybody's got the Robinhood app. Everybody's online at Fidelity, trading stocks like crazy. That's cool, right? Every day the market's going up. It feels great, makes us all happy. But the real world, which is generating the earnings, is not in the same position as the markets. And can you bring that chart up one more time for me, Brent? What you'll notice is that previous peaks where consumers were extremely optimistic about the markets typically marked peaks in the market. Not tomorrow, right? Could be next year, but we're at those kind of points in time to where expectations start to revert in the stock market as reality begins to set in a bit. Okay, quick break. We're going to come back. Get ready to wrap up the show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Just a few responses to your comments in my chat this morning. I was not wearing rubber boots. I was wearing my rubber suit as usual. No. But yes, it was quite comical last night because my dogs are very funny. They have very vibrant personalities. One is old as dirt, and we think we don't have much longer with him. He's having seizures as of late. So my oldest dog, he's 11, about to be 12. He was born on Halloween, so he's about to be 12, but I don't think he's gonna be with us much longer. And my youngest is about 3 years old, but they have very, very funny personalities. They're very funny dogs. And last night we walked into the hotel with these two dogs on leashes, and they're having. I'm not part of the Indian culture, so I don't understand all the kind of events they have. But they had some big event, like maybe it was a wedding. I'm not sure. So forgive me if you're Indian and I butcher whatever celebration issue is going on right now. But the place was just covered with, I mean. Like hundreds of people. It was completely packed with women dressed in traditional Indian garb, very beautiful. I mean, just fantastic, clothes that they were wearing, and they were having this really big event. Well, they're all down in the lobby when we go in, and you would think that we had celebrity dogs, because when we walked in, everybody was like pointing, coming over, wanting to pet the dogs. So yeah, they were in heaven last night, because they thought they were celebrities when they walked into this hotel. But yeah, it's always quite humorous. So a couple of things I've talked about before is about homeownership, and we've done a terrible disservice to individuals since the turn of the century. And you have to kind of go back in history and look at, what happened. And, when you take a look at people today and you say, well, why don't you have any money saved up? Why are you house rich and, asset broke, that type of thing? It was because we started to change policies at the behest of the National Association of Realtors lobby group, right? National Association of Realtors lobbied heavily to get changes made to the mortgage process so they could sell more houses to people. And so there was a big push in 1999 heading into 2000 for adjustable rate mortgages. Now remember, prior really to about 1998, in order to buy a house, you had, and for some of you this may be too old for you to remember, but you had to have 20% down on a house. That was it. I mean, you wanted a mortgage, you had to put 20% down, you got your mortgage, and then you went on your way. Well, then the mortgage industry started figuring out, well, how can I get around that 20%? Well, I can take out a second mortgage for the 20%. So now I can take an 80% mortgage on the first, 20% on the second, and then I can avoid the PMI that way. So I wouldn't have to pay mortgage insurance. And then we came out, but again, that wasn't good enough, right? Because people still needed a down payment. So we had to come up with a better way. And so Alan Greenspan, at the behest of the National Association of Realtors and other lobby groups in the real estate industry, started promoting adjustable rate mortgages. And we need these adjustable rate mortgages. This allows people to get in at a lower rate. And then after a certain period of time, 10 years, whatever, it adjusts up, right? So you can take a lower rate now, but later on, you're going to wind up paying for it. And so everybody's like, oh, that's a great idea. I can buy a house. Well, the problem with this ultimately led to subprime mortgages. This was that free drop of crack cocaine, right? It's like, hey, just try this. You'll be fine. You'll love it. And then of course, once you were hooked on it, we had to come up with a whole other ideas to get people, fed for their addiction for housing. And this is why we have this housing crisis that we have today with, unaffordability, et cetera, because we made houses a speculative commodity instead of it being something that you earned your way into. In other words, you could save up a 20% down payment, which allowed you to afford the home. And this is what everybody misses. Like, oh, I've got to own a home. No, you don't got to own a home. You just need to be able to afford the home, right? There's nothing wrong with renting. We make this idea that rental is terrible. There's nothing wrong with it. It just means you're not ready for home ownership yet. And if you can't save up a 20% down payment for the house, you're not ready to own a home. Why? Why is that important? Because as anybody will tell you that owns a house, it's very expensive to own a house. It's maintenance, it's upkeep, it's insurance, it's homeowners, it's all this other stuff. Just the mortgage payment's one thing. But you got all this other stuff that goes along with it. So if you can't save up a 20% down payment, that means you don't have the free cash flow to deal with all the other crap that goes along with home ownership. And it's every month. I mean, it's every month something comes up, it seems like. I mean, you know, your house is about to burn down with electrical fires. You know, those type of things happen all the time. Like, you know, a refrigerator goes out, washer and dryer goes out, you know, squirrel burrows into your house, you know, whatever. I got all kinds of crap that goes on with this rental property, but, you know, that stuff happens. And so if you can't save up to 20% down payment, that means you don't have the free cash flow to deal with all the other advents that come along with home ownership. And so it just, you know, it provided a barrier of entry that made you a responsible homeowner, and you could deal with it. And you didn't have to, basically destroy your financial wealth to try to own a home, because National Association of Realtors is going, oh, everybody needs to own the home. It's an American dream. No, that's not the American dream. Home ownership is not the American dream. It is the recognition that you have achieved the American dream by becoming successful financially. That's the reward. I'm successful financially. I can now afford to own a home. I have achieved the American dream through building my business or whatever it was, becoming successful at my job, whatever it was. That's the American dream, right? Home ownership is the symbol of the achievement of that American dream. And so I'm very anti-adjustable rate mortgages or anything that allows you to skirt that 20% down payment, because it just makes sure, all those things do is just ensure that you get yourself into a position that you are going to wind up financially stressed at some point. There was a chart out this morning that just proves my point. This is a graph of adjustable rate mortgages and what are you most likely to do once that fixed rate period ends and everything adjusts up, right? So 32% of people say, I just got to keep paying as usual, right? Now, it doesn't tell you what else is going on in their life, right? But they're going to keep making that payment. What is everybody else doing? Cutting expenses, taking on additional work, using savings or investments, other. That's a huge one. 33% is other. I don't know what other classifies, but it's not good. And 10% are going to default or delay on payment. All this chart tells you is that they bought houses they can't afford. Because if you could save up the down payment and you could get into the house at whatever the normal mortgage rate was and you could afford that, that's fine, right? But if you've got to take on an adjustable rate mortgage to get into the house, you've got to get some teaser rate. This is what's going on with a lot of these home builders right now to move properties. They're giving you a 4.4, 4.5% loan for the house. Well, what they don't tell you is that thing resets in 2 years to whatever the current mortgage rate is. So it's like, oh, I can go buy this new house and get 4% on it. And then in 2 years, your mortgage is 7%, right? And you can't afford it. So again, all adjustable rate mortgages tell you is that exactly what this thing says is that, yeah, you could get into the house cheap. That's great. You're now a homeowner. Congratulations. You own a home. And all the crap that goes along with it, you're now the owner of that. And as soon as that mortgage rate goes up, you're financially done. That adjustable rate mortgages are the worst thing that we ever did to the average American. Adjustable rate mortgages, subprime, any variation other than put 20% down, here's your mortgage rate, go buy a house. Everything other than that facilitated a financially destructive outcome to the average American. Now, and look, if you got tons of free cash flow, who cares? Do whatever you want. In the end, if you're making a lot of money and you want to use an adjustable rate mortgage, and I know a lot of people, I did this, right? I took out an adjustable rate mortgage on my house back in 2000. I bought a house that was basically about to go into foreclosure in 2008. I took out an adjustable rate mortgage. At that time, I got like 2.8% on my adjustable rate mortgage, and it was going to reset in 7 years. I had no intention of keeping that house for 7 years. Right. So I knew I was going to sell the house coming out of the financial crisis. So I bought the house cheap, took out a super low interest rate mortgage, and I knew I was selling the house within 5 years, which we did. We sold the house in 2015. So that's fine. If you have an outcome, there's times to take advantage of these products. I'm not saying you shouldn't take advantage of these products, but you need to be financially capable of understanding what you're getting yourself into, and realize what the outcome of that is going to be if you're not out of that property by the time, or have it paid off by the time that adjustable rate mortgage resets. Now, look, a lot of people have plenty of cash flow. I get it. And I can take out a cheap mortgage now, and if it resets in 7 years, I'm still in the house. Great. Doesn't affect me at all. That's okay. Use the adjustable rate mortgage, save yourself interest for a few years. Maybe rates will come down 5 or 7 years from now, and you'll just roll over into a lower rate. So I'm not saying this isn't for everybody. I'm just saying that if your first look at home ownership is how to get the cheapest rate just so you can afford the payment, you are not able to afford the house. Don't buy it. Work on your cash flow, work on your savings, get yourself in a position to where you can financially afford whatever comes with that lovely thing that we call home ownership. All right. Thanks for joining me today. Thanks for listening to my rant. And we'll be back tomorrow. We'll see what happens tonight with the house. I'll update you tomorrow. If it's still standing, we'll see. All right. See you tomorrow.